Hello and welcome to this Select 50 Fund Manager interview. I'm joined today by Mark Nichols, co-manager of the Threadneedle European Select Fund. Mark, welcome along. Let's start by talking about the fund's name then. A European fund, clearly, but select. What does select mean in the context of your fund?
Sure. It's quite simple in many ways. It is a selection of our best ideas in Europe. What do we mean by best ideas? Well, for us, a good idea really is a business that can deliver consistent returns over a very long period of time. So compounding high returns on capital. What it's very clearly not as a portfolio is something trying to replicate a benchmark. And we are not in any way compelled to hold big positions just because they're large components of an index, for example.
And so does that lead to differences in performance of your fund, say, versus a different type of active fund or indeed an index fund?
Yeah, so we should have quite large divergences from any particular benchmark or index, and that then creates the opportunity for the portfolio to deliver quite attractive rates of return and quite significant divergences, not just in positioning, but also in performance relative to, say, an ETF or a benchmark.
Indeed. Let's turn to process then. How do companies make it into the fund?
Sure. So we're very focused on modeling free cash flow. We're looking for businesses that can consistently deliver that cash flow year in, year out, regardless of the economic backdrop or the cycle backdrop, so consistent performance. We're looking at businesses that can take that free cash flow and reinvest it for more attractive rates of return or more growth in the future, rather than diluting it away, throwing it away on big acquisitions that never earn a return in the future. We're not looking for empire builders. And we're doing two specific pieces of research to try and identify those kinds of company. So one is we're looking for sustainable competitive advantage. That might be branding. So take Jameson's Irish Whiskey, for example. That's one of Pernod's brands. Completely dominates its category, is known all over the world and has delivered consistent growth as a result of that. The second thing we're doing is we're looking at management teams. We're trying to understand their incentives, and we're trying to understand how well aligned they are to shareholder interests. Quite often what we end up with are owner-operator type business models, where either you've got someone who does own a large chunk of the company, or you've got management teams who are paid to think like owners of the business. Okay,
notwithstanding those sorts of traits, are there any other biases that process leads to in terms of style of company, growth versus value, quality?
Yeah, we are unashamedly looking for businesses that get characterized as quality franchises. We want them to be able to repeat the growth, repeat the high rates of return on capital year in, year out as time passes. It's that compounding effect that we're really looking for. And so we need some element of growth aligned to the quality. What we're very specifically not is a value manager. We are not looking at low PEs either as a measure of value or as an indicator that we should be starting a position in a particular company or a particular share.
Okay. Europe at the moment, it seems to be on the end of various disputes on the geopolitical stage. You've got its arguments with Russia, you've got Trump now talking about a trade dispute and the EU being an opponent potentially for the US, and of course we have Brexit. How much does all of that factor into your thinking? How much have you had to pay attention to those kind of issues?
Yeah, we like to talk very proudly about how we're bottom-up investors. We like to focus on particular types of business and the characteristics that make those businesses attractive. And we like to try and put the macroeconomic environment to one side. The reason we feel comfortable often doing that is because we're identifying businesses that tend to be global leaders. So they're not confined just to operating in the US or the UK or Europe or any particular local or regional market. The reason they can operate in that global environment typically is because they have a product or a service that's very difficult to replicate. Sometimes they'll be the only provider of that service or product. And what they tend therefore to be doing is setting the price for that product or service. They're not just taking the prevailing market price. And so they're much less prone to disruption from, say, trade wars, tariffs, etc. They can move the price of a product, let's say cognac, for example. You can only make it in France. That provenance is crucial to you being able to set the price of the product based on the heritage, the flavor profile, for example. Things that aren't the same if you buy a bog standard off the shelf brandy or whatever other drink you like to have. And so in that regard, their ability to determine the value of that product to their customer, in some ways at least, mitigates a lot of those macro questions. At the same time, I think it's fair to say, as a European investor and someone who's been doing it for quite a long time, we're pretty used to political disruption and dispute. Elections come around in at least one member state in the EU, typically every year, typically more often than that. And so seeing changing leaders with different objectives, hearing politicians talk about their goals and their objectives is nothing new to us. And it's worth bearing in mind that over the life of the companies that are invested, that the fund is invested in, the portfolio holds positions in, which will sometimes be in the portfolio for a decade or more, politicians come and go. The companies have endured, and we believe they will not just endure, but prosper.
And that characteristic you talk about there is referred to sometimes as pricing power, isn't it? And I guess that goes hand in hand with what you said at the start of this, which was in identifying companies, you're looking for really, really strong and unique brands, among other things.
Yeah, I mean, there are many different sources of competitive advantage that we look for. Branding's a good example, but we would identify things like switching costs. So if you as a business decide to install a very expensive operating system, a piece of software that helps your productivity, you're more likely to buy the inexpensive add-on to update it next year than you are to rip it all out and start again with a whole other product. So we're very open-minded in terms of what that competitive advantage really is, but we're not very open-minded about how durable it is. It has to be something we can believe in for the long term. It's what helps give us conviction in the business's ability to keep generating that cash flow that we're so focused on.
Okay, finally then, let's talk about Brexit. A lot of the discussion in this country, of course, people are going to be used to British companies under threat from losing their privileged access to the EU. You're talking to companies on the continent. Are they having similar comparable conversations? What are their preparations and how worried or not are they?
Very simply, the companies that we're investing in the portfolio, the answer is no. We haven't had a single discussion with the management team where we've raised Brexit as an issue we want to have answers to in terms of planning and so on. It's clear that there are businesses in Europe that do more or do less in terms of their trade with the UK. The characteristic of the companies we're invested in this portfolio is that they tend to be much more geographically diversified in terms of their sources of income. And so we would be hard pressed to identify a business where the UK is a key economy for any of those businesses. So in our experience, no.
Mark, that's all we have time for. Thanks very much for joining us. Thank you.
Thank you.